I don't think I give a shit about my legacy. That's not what matters. In the end, it's the mark that we actually leave on the world, not the mark we're perceived to leave on the world, that matters.
In an industry known for speed and scalability, it seems fitting one of the world's largest cryptocurrency exchanges imploded within days. The rise and fall of FTX revealed holes in the crypto space that industry peers, the media, and government officials either chose to overlook or refused to question. Beneath the promise of a decentralized financial future for the world stood a fragile ecosystem pioneered by young, ambitious founders determined to move mountains under the guise of effective altruism, a trendy philanthropy movement among tech founders. FTX's fallout wasn't the only concerning news out of the crypto industry in 2022. It follows the decimation of Lunacoin and the Voyager scandal, which leaves us wondering, can the public and government legislators trust the crypto system?
Back in 2017, the crypto world was riding a pretty chaotic wave at that time. That was during what was known as the ICO boom, or initial coin offering, where if you had an idea for a blockchain project, you wouldn't necessarily go to Silicon Valley venture capitalists on Sand Hill Road. You could actually just put out a white paper, create a wallet, sell tokens to investors, and people were able to raise tens of millions, sometimes hundreds of millions of dollars in a very quick amount of time. However, in 2018, the crypto market subsequently crashed. Bitcoin fell to under $4,000. There was a real fear that the market was going to completely bottom out. I remember some crypto folks just continuing to buy because either they felt that they were going to go down with the ship, or if Bitcoin and crypto recovered, they were getting the deal of the century. What really turbocharged all of this was the pandemic, and more particularly the response from the US Federal Reserve, its central bank, and central banks around the world that injected trillions of dollars in liquidity into the global economy to help people make ends meet, until August of 2020, when Michael Saylor, the ex-CEO of MicroStrategy, made a $250 million purchase of Bitcoin for his company's balance sheet, making it the primary treasury reserve asset. It turned out to be the beginning of what was a major influx in institutional capital into Bitcoin. That led to a tsunami of interest, not just because, okay, look, here are these big publicly traded companies that are interested in the asset, but by this point, everybody was flush with cash.
It was around this time that crypto latecomer Sam Bankman-Fried started to make headlines.
He launched a quantitative trading firm called Alameda Research and found a way to exploit price differences in Bitcoin in different parts of the world to make a sizable fortune. In particular, he bought them cheaply in the United States and was able to sell them in Japan for up to 30% more. He did that for a couple of years, and then he ended up rolling some of those profits, as well as taking on some new investors to create his exchange FTX. One of his investors was Changpeng Zhao, the founder and CEO of Binance, which is the largest crypto exchange in the world.
FTX focused on a particular type of trade called derivatives, which are used as a hedging tool to help traders and people manage risk. FTX stands for Futures Exchange, and it was built specifically to handle those types of trades.
FTX was a pretty good product. People liked it. It was advertised as by traders for traders, and institutions trusted it. They, at some point, actually had a lot of money. Although looking at the balance sheet that came up, looks like a large portion of it was coins that they themselves effectively created.
Those coins created by FTX, which ultimately contributed to the company's downfall, were known as FTT.
FTT belongs to this weird class of cryptocurrencies that are created by exchanges, and you can think of them as loyalty points because they give users all these perks on exchanges like discounts on trades. FTT is kind of a utility token. It doesn't represent an ownership stake in FTX, but in a certain way it is similar to a stock because it is associated with a company.
When FTT tokens first hit the market, they were performing well.
FTX itself was established in this weird time in 2019 when kind of the big bear market almost ended, and FTX hasn't really experienced any of the big drawdowns that other exchanges saw before. It was a latecomer. So FTT was also just going up. I think it was worth over $20 at some point.
It appears that FTX and Alameda were using FTT, the token that FTX created, as one of the largest assets in their balance sheets, and were allegedly loaning money against it.
There's lots of questions about the intrinsic value of Bitcoin, Ethereum, other tokens out there. Many people that don't follow the industry closely will say it's just a bunch of digits on a piece of paper. What's backing it? The question about intrinsic value for tokens like FTT and BNB and CRO and so on and so forth is even murkier. Essentially, the intrinsic value is just based on different types of benefits and privileges that you get for using an exchange, like trading discounts or increased rewards for if you lend your tokens on the platform. The problem, though, is a lot of these tokens trade on exchanges around the world, and people buy them as a proxy for owning stock in those companies. Many people bought FTT because they kind of felt that directionally it was going to be closely correlated with the fortunes of FTX.
FTT had the trust of traders and investors alike, and buy-in for the token was making Sam Bankman-Fried and others incredibly wealthy.
Our cover story was really the first big profile of Sam Bankman-Fried in a magazine, and it really looked at sort of his background and how in a very rapid period of time he became the richest 29-year-old in the world. At the time that we did the story, I think we had him valued at $22.5 billion, although a lot of it was illiquid, locked up in FTT tokens that played a role in the downfall of all of this, and FTX equity. A lot of people are asking, why did nobody realize this sooner? I will say that there were certain warning signs there. I mean, for one, the ties between FTX and Alameda were largely known. The first time we even looked at Sam Bankman-Fried's wealth, he shared a spreadsheet with us breaking down his token holdings and the various assets that he had. It was in pretty non-traditional and somewhat illiquid tokens.
FTX appeared to be a very profitable company.
FTX only has about 300 employees. Payroll is typically the highest expense that an exchange has. The overhead is basically a software company. The overhead's very, 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 very low. So all of those things combined, plus the fact that subsequently he started raising money at massive valuations all the way up to $32 billion from some of the most esteemed investors in the world, the Sequoias, the SoftBanks, the Tiger Globals, etc. For all intents and purposes, he was a multi-billionaire.
If the events in question were happening at the time of Forbes' cover story, it's possible that they were hidden by the bull market. But on November 2nd, 2022, FTX's facade was shattered in a matter of hours. Alameda Research, FTX's sister quantitative trading firm, had large holdings of FTT, which it used as leverage to make risky, speculative bets on other cryptocurrencies and complex financial products. It also became clear that Sam Bankman-Fried might be using customer funds through FTX to help keep Alameda Research afloat. As long as the price of FTT remained stable without a rush of FTX customer withdrawals, the whole operation could appear solid.
CoinDesk published a copy of Alameda's balance sheet, which showed that a lot of its assets were in FTT, which is kind of an exchange token used to get discounts and stuff on FTX that is pretty illiquid. And when that happened, that caused a lot of people to get scared. The real catalyst for all of this is when, shortly after CoinDesk published that article, Changpeng Zhao, CZ, announced that he was going to sell about $500 million of FTT on the open market. This automatically created a lot of fear and doubt among FTT holders.
After CZ decided to offload his exchange's FTT holdings, investors pulled out en masse, which tanked FTT's worth and Sam Bankman-Fried's operation. In 24 hours, the coin went from around $22 to under $5, wiping out more than $2 billion in value.
Ultimately, what happened was Sam Bankman-Fried reached out to CZ, his earliest investor, to see if Binance would be interested in acquiring FTX. Binance and FTX signed a letter of intent, but it was non-binding. About 24 hours after that letter was signed, CZ and Binance announced that they were going to walk away from the deal, that there were too many problems at FTX, and then eventually the company decided to file for bankruptcy, Chapter 11, Bankman-Fried stepped down as CEO, and now once again the industry is trying to deal with the fallout of that, and now we're also trying to understand the subsequent collateral damage that's coming from this bankruptcy, because Three Arrows Capital was seen as sort of at the hub of major trading desks and firms around the world. FTX was orders of magnitude bigger.
So how did no one realize earlier that the math behind FTT was suspicious?
There's a lot of finger pointing here. Who was responsible? The media, the investors, politicians. Media definitely has a responsibility. We do. What was, I think, very interesting about Sam is that compared to other crypto billionaires, he was very friendly, talkative, open. He was always somewhere giving speeches, giving interviews. He was easily accessible any time of day and night. He gave information that no other crypto billionaire or executive of his scale gave, which in hindsight is also a red flag.
Gary Gensler, who is the head of the Securities and Exchange Commission in the US, is also in an awkward position.
This is the chief financial cop. FTX was getting away with what it was doing right under his nose. Gary Gensler has taken a very forceful stance on crypto since entering his position under the Biden administration. He's made it a priority to crack down on fraudulent coin offerings. Just last month, he had a very high publicity charge of Kim Kardashian over promoting the Ethereum Max coin. It seems that some of these smaller fish were distracting his attention from the big fish, which of course was FTX.
I think there's still a lot of uncertainty because technically FTX International was based in the Bahamas. There was also FTX US, which was based in the US. A couple years ago, the Bahamas passed a digital assets focused legislation that led exchanges like FTX to domicile in the islands. It wouldn't be right to say that FTX wasn't regulated. It was regulated by the Bahamian authorities, but I think the questions that everyone will be asking now is, well, what kind of oversight they had. Now there are reports that some employees or people who worked with Sam on other projects tried to raise those issues, but they were quickly shut down because of the influence that he commanded, because the industry is so small. There's a discussion about making it a requirement for exchanges to come up with proof of reserves, which is basically a way to prove cryptographically that centralized entity has enough assets against the liabilities. CZ, the CEO of Binance, the company at the center of this whole thing, came out and said, I haven't been too vocal about issues that I saw, but maybe I should start doing it.
Many people took it at face value that there was enough of a separation of duties between FTX and Alameda or Gap that no major conflicts of interest would actually arise. Obviously, that does not necessarily seem to be the case. The biggest trigger for what happened, and this is all still being reported out, so no one really knows for sure exactly what happened, but it appears that Alameda was a victim of the fallout that stemmed from earlier volatility this year when the Terra USD and Luna ecosystem, $55 billion for essentially a stable coin, completely got wiped out. That led also to the fall of Three Arrows Capital, a multi-billion-dollar hedge fund based out in Singapore, bankruptcies of a crypto broker, Voyager, that traded on the Toronto Stock Exchange, and a lender called Celsius. People always wondered, okay, is that the collateral damage? Is that the extent of this? But crypto is such an integrated industry, and despite its decentralized and open, transparent nature, it is pretty obfuscated. It appears that Alameda was part of that. And the real cause of the downfall was that Alameda was getting margin called, which means that it had taken out leveraged positions and had to post more collateral when those positions became less valuable, and they needed additional assets and collateral. FTX, despite user policies saying that they would explicitly not do this, gave customer deposits to Alameda. Sam Bankman-Fried claims that he did not realize that was what was going on, but that does seem to be what happened.
Another driving force to FTX's ruse that may have warded off closer scrutiny was Sam Bankman-Fried's philanthropic ethos. Bankman-Fried regularly spoke of effective altruism, an academic and social movement geared around maximizing the most good for the world.
At a high level, you cannot understand the rise of Sam Bankman-Fried and FTX without taking into account his focus on philanthropy and his profession of effective altruism.
I got into finance in the first place to try and maximize the amount that I can donate to some of the most effective causes. And I'd certainly love to be spending more time thinking directly about what these projects can be working on. But my main role right now is to do what I can to help support them financially or any other way that I can.
Sam Bankman-Fried's giving and his talking about his giving was core to the image that he presented on Capitol Hill, in the press, with celebrities, with the broader public. Philanthropy made Sam Bankman-Fried unlike any other crypto entrepreneur we've seen before. This was not somebody who cared about decentralization or those core tenets of the crypto movement. This was somebody, a self-professed capitalist for the purpose of giving it all away. Effective altruism received a lot of money and a lot of press from FTX, while FTX gained the reputational advantage of being this group of philanthropists and givers, and that's what made them stand out in crypto. And I think it brought them a level of mainstream acceptability and cachet that other crypto companies haven't seen to date. Sam Bankman-Fried's donations to Democrats do leave them in a bit of an awkward position. He was one of the biggest givers during this last election cycle, and there have already been calls for candidates and politicians to give those funds back. That being said, Republicans also received a lot of money from FTX. Ryan Salam, one of FTX's executives, gave about $24 million to Republican candidates. I think the really interesting question is, for charities that did receive money from the FTX Foundation, will they get to keep that money, or will they have to give it back through bankruptcy court? Restructuring experts I've spoken to said there is a chance that they're going to have to give that money back. So it really depends on whether it's determined that the philanthropy of FTX was part of the broader scheme to allegedly defraud customers of their funds. And if that's the case, then those secondary transactions, the money that went from the FTX Foundation to charities, that could be clawed back.
FTX's ripple of destruction is still unfolding, but the damage to the larger industry could be everlasting.
I think the big worry for everyone, especially within the industry, is that regulators will take away wrong lessons from this situation, that they will come in and start regulating even more when there is not enough clarity. It's important to understand that it's precisely lack of clarity and uncertainty that drove a lot of companies, including FTX, offshore, where they could set up shop in jurisdictions where the rules weren't as strict, or where they could buddy up with regulators better.
One of the real messages that's going out day and night from crypto entrepreneurs and executives that remain is that people really need to think carefully about where they hold their tokens and how they secure their assets. Because if there's one thing to know, it's that if you see a balance on an app or a computer screen, that doesn't necessarily mean that it's there. And that you really need to make sure that wherever you store your tokens, if you store them with someone else, that they have good risk management processes in place, they have been audited, and that they don't necessarily engage in potentially risky behaviors like lending and trading, or at least don't do so without proper consent from the customer.
Another thing to be said here is that FTX didn't really have a real board of directors. There's a meme where everyone stands in circle pointing at each other. You did due diligence and you did due diligence. So who actually had a look into what was happening early on and was able to say, oh, here's something weird? Everyone wanted to believe in Sam, just like in Elizabeth Holmes and many other similar cases. We are yet to see what will happen with Sam Bankman-Fried and Alameda, but this is what the industry is looking at.